Imagine waking up one day and discovering your credit score just dropped. And because of that, you now have to pay thousands of dollars more in loan interest. In America, your credit score secretly controls almost everything. The car you can buy, the house you can afford, even the credit cards you qualify for. But here's the crazy part. Most Americans don't actually know how credit scores work. So before we talk about improving your credit score, you first need to understand how the credit score system actually works. In the United States, most lenders rely on something called the FICO score. This score usually ranges from 300 to 850, and it acts like a financial reputation score. The higher your score, the more trustworthy you appear to banks and lenders. And that single number can determine things like the interest rate on your mortgage, whether you get approved for a car loan, and even which credit cards you qualify for. But here's the important part. Your credit score is not random. It is calculated using 5 specific factors, and each one has a different level of importance. Payment history, 35%. The biggest factor affecting your credit score is payment history, and it makes up about 35% of the total score. Lenders want to know one thing above everything else. Do you pay your bills on time? If you consistently pay your credit cards, loans, and other debts before the due date, it shows lenders that you're reliable. But if you miss payments, especially by 30 days or more, it can seriously damage your credit score. In fact, even a single missed payment can cause your score to drop 50 to 100 points, depending on your credit history. That's why payment history is considered the foundation of your credit score. Credit utilization, 30%. The second most important factor is called credit utilization, which accounts for roughly 30% of your credit score. Credit utilization measures how much credit you're using compared to your total credit limit. For example, if your credit card limit is $10,000 and you've spent $5,000, your utilization rate is 50%. High utilization can signal financial stress to lenders. That's why experts recommend keeping your utilization below 30%, and ideally even below 10% if possible. People with excellent credit scores usually keep their balances very low relative to their credit limits. Length of credit history, 15%. The third factor is the length of your credit history, which contributes about 15% of your score. Lenders prefer borrowers who have demonstrated responsible credit behavior over a long period of time. That means older credit accounts can actually help your score. This is why many financial experts advise people not to close their oldest credit cards, even if they don't use them often. Those accounts help extend the average age of your credit history. Credit mix, 10%. Another factor is something called credit mix, which represents about 10% of your score. Credit mix refers to the variety of credit accounts you have. For example, credit cards, auto loans, student loans, or mortgages. Lenders like to see that you can manage different types of credit responsibly. But this doesn't mean you should open unnecessary accounts just to improve your credit mix. New credit inquiries, 10%. The final factor is new credit inquiries, which make up the remaining 10% of your score. Every time you apply for a loan or a credit card, lenders perform a hard inquiry on your credit report. 1 or 2 inquiries usually won't cause much damage, but applying for many credit accounts in a short period of time can make lenders think you're facing financial trouble, and that can cause your credit score to temporarily drop. Closing line. So when you combine all 5 factors, payment history, credit utilization, credit history length, credit mix, and credit inquiries, they create the credit score that lenders see. Every year, millions of Americans struggle with low credit scores, not because they're irresponsible, but because the system is confusing. Banks don't exactly advertise how the credit system works, because the truth is, a bad credit score makes banks more money. Higher interest rates, higher fees, more profit for lenders. And the difference between a 620 credit score and a 760 credit score can literally cost you tens of thousands of dollars over time. Improving your credit score doesn't require magic. It requires understanding how the system works and using it to your advantage. Pay your bills on time, keep your credit utilization low, and avoid unnecessary credit applications. Follow these steps consistently, and your credit score can start improving faster than you think. Because in the modern financial system, your credit score is one of the most powerful numbers in your life.